Welcome to SilverOak's quarterly webinar. This webinar is scheduled for 45 to 60 minutes in length, and a copy of it will be posted to the SilverOak website. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with a SilverOak advisor, you can contact me directly at 952-896-5701. And to introduce myself, I'm Shannon King, a president and partner, as well as chief compliance officer for SilverOak. And with me today is Jonathan Charlo, partner as well, and our lead analyst. Of course, Jonathan, I want to thank you and John and the rest of the team for making today's session possible, including everybody on the technology side. I know it really does take a village to make this happen. And since I am the compliance officer, for compliance purposes, I must note we will be discussing the overall markets and economy during the webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last week or so. If you have any specific questions, feel free to reach out to your SilverOak advisor if they've not already reached out to you. And lastly, as they say, past performance is no guarantee of future success. So Jonathan, let's take a look at the agenda. We're going to start off as usual discussing the economy and going through the SilverOak dashboard. Then we'll transition to a discussion around market performance. We will discuss SilverOak's outlook moving forward, both from an economic perspective and from a market perspective. And then at the end of today's session, you put together some planning tips for the new year, as well as some exciting SilverOak updates of things that are happening here internally. Of course, I encourage anyone that has questions to reach out again to your SilverOak advisor. And for that matter, if you even have suggestions for future topics you would like to discuss, we're happy to entertain those. So let's start with the economy and SilverOak's dashboard and take a look at that. So what are we seeing here on the dashboard, at least as it relates to the economy component?
Well, certainly when we look at fourth quarter economic data, it was fairly neutral, kind of very similar to what we saw in the third quarter. Now we are also showing the projections for 2026, and we are projecting that it will become slightly positive during the first quarter.
All right, that's encouraging. How about the credit markets?
Credit markets have already been kind of in that positive vein. You can see it on here, but it is a little darker for the fourth quarter, and we'll show that meaning better, even better than it was last quarter. And we'll show a slide kind of going through that, but the yield curve is actually steepening, which is a positive sign.
Yeah. And I would say if we look here at the credit market, certainly positive, but we have them kind of wavering on positive versus quite positive. Valuations. Wow, this hasn't changed much.
No, valuations remain high, and actually later in the webinar, we'll maybe discuss why that is in terms of the composition of the market and how it's changed.
Market sentiment, which is the last major component of our dashboard.
That remains positive. Now, at one point last year in the second quarter, which included April and kind of all the tariff turmoil, we did see market sentiment in the market come down, but it did recover quickly and remain solidly green.
Perfect. And again, just to remind those who maybe haven't joined in prior webinars, These are the four major components that make up our dashboard. But within each of those components, there's subcomponents that we're actually measuring that give us the results here. And then, of course, we take those four major components that we've referenced here, and we put them into a composite. And right now, Jonathan, it looks like we're remaining relatively neutral, but in the latter part of next year, maybe going to a slight positive position on the overall composition.
Yeah, absolutely. And we'll see that on the next slide, that we're just kind of right below that kind of green area. So again, our projection is that that will improve. We're saying at this point in the second quarter, but you know, that again is just a projection.
Got it. Well, let's take a look at a couple of the components of that dashboard, and we'll start with the economy as being the major component, and then the subcomponent being the ISM indices.
Yeah, so here we're tracking both the manufacturing and the non-manufacturing. The non-manufacturing is in blue, and you can kind of see right near the end that that's actually going up. So the kind of consumer part of the economy has been strong, and that is the majority of the economy. Whereas the black, you can see, has been kind of, it actually spiked up at one point about a year ago, and then has kind of come down and then been kind of flattish. And that's really signaling what we're seeing in the manufacturing part of the economy.
All right, another component of that dashboard economy piece is unemployment.
Yeah, and so we can see really on the bottom that has been tracking up, still remains fairly well positioned when we look back at other parts in history. More recently, it did come down just a little bit, but the other thing, and we mentioned this later, is the Fed is definitely watching the labor markets today.
A third component of the economy is housing starts.
Yeah, so this has been another area besides manufacturing where it has been weak. We really did see a bit of a tick up coming out of COVID, but housing starts have been kind of solidly flat to down in the last year. There has been a thought that with interest rates coming down, that maybe we would see mortgage rates come down, but likely they're still not at a level that might spur some strength in housing starts.
Got it. Well, and these were just a couple of the subcomponents of that economy piece of our dashboard. There's actually, I think, 24 subcomponents. So again, this was just a couple that we wanted to touch on. Let's transition now into credit markets and the yield curve. So what's that looking like?
So basically, the yield curve, as I mentioned, the slope is actually becoming a little bit stronger, meaning that if we look at the green and the black near the end, those are going up. And that means that the yield curve is becoming more positively sloped, which means that longer maturities have higher yields than shorter maturities. And that tends to reflect when the economy is doing well.
Got it. And spreads?
We did last year see a period where those spreads widened a little bit in that second quarter, but they have come back down. And typically you see spreads widen ahead of economic weakness. And so kind of there being flattish right now is kind of a signal that there's not currently a worry about a recession.
Got it. So let's transition from the credit markets into valuations. So what are we seeing here with corporate earnings?
Corporate earnings are definitely improving. In 2025, we definitely did see good earnings growth. And in 2026 and 2027, and we'll have a slide later, the expectations are for continued earnings growth.
Got it. And finally, let's touch just briefly on sentiment, or at least one component of sentiment, which is market trend.
And essentially here, what we're looking at in black is the performance of the market. So it's been strong, and you'll see kind of a green line and then an orange line. The green line is the 50-day moving average, and the orange line is the 200-day moving average. And you can see that both are kind of heading up and to the right, and that tends to signal bullishness. And so from that standpoint, the market has a good bit of momentum.
Got it. Well, I know that was rather quick and in some regards, maybe a little bit technical, but really what it boiled down to, at least for the last, quarter or year, is quite strong market performance. So if we look at the equity markets, certainly for the quarter, we had good performance. But for the entire year, it was a pretty exceptional period. U.S. large cap stocks, as you can see here, were up almost 18% if you're measuring it via the broad-based S&P 500. Mid caps were up double digit. Small caps, that was an interesting one because there's two kind of widely utilized benchmarks in the small cap category. One being the S&P Small Cap 600, which is what we tend to favor, and the second being the Russell 2000. And you can see that the Small Cap 600 was up 6% for the year, whereas the Russell 2000 was up more than 12. That is a massive deviation of performance in what presumably you're measuring the same part of the market. So explain, Jonathan, why there's this big deviation in, again, kind of that small cap market.
Well, certainly when we look at the S&P Small Cap 600, there are 600 names. There's a committee that actually votes for companies that are included in that benchmark. And they do have a profitability hurdle, which interestingly, when we look at the Russell 2000, of course, it's more companies, but it has a lot more non-earning companies as a result. And so what this implies is that some elements of the non-earning companies within the Russell did well this past year. Whereas we feel over long periods of time, the S&P 600 really includes more quality small cap companies. And so that's why we use it.
Yeah, I think that Russell, it's about a third of those companies are non-profitable companies. And we have seen periods where they will outperform, but again, over time, I have to believe quality is gonna win out. International, that's another area where we give two numbers. We show the MSCI ACWI All Country World Index ex-US at 32% in US dollars, but 24% for the year in local. And that differential is obviously currency because the dollar was weak during 2025. When you convert those local dollars to US, you get an added boost from 24 to 32%. So that was quite a benefit. Didn't see quite as much benefit on the currency side with the emerging markets, but still, a slight advantage.
Yeah, when we look at the dollar, it was particularly weak against the euro. And so euro markets are a bigger part of the MSCI ACWI, hence the difference.
Got it. And then as we transition over into the bond markets, again, for the most part, the bond markets were relatively good. REITs, real estate investment trusts, they were down slightly for the quarter. But if you look for the year as a whole, bonds did quite well, pretty much across the board. Again, there was a slight advantage if you were in global fixed income because of the currency benefit that you got from that. But still, U.S. ag up more than 7%, 7.3%. Even REITs were at least positive. They eked out a slight benefit there. So going back to the equity discussion, this is showing us styles. So growth versus value. and small cap versus large cap. And what really do you think stands out here, Jonathan?
Well, certainly when we look in general, certainly large cap, we see growth having done better than value, and that's a fairly large gap. And again, within large cap growth, there's a lot of technology, and we'll get to that on another slide. But certainly when we look at the quarter, though, which is in yellow, value had a slight advantage over growth. And we'll see, interestingly, within mid-cap growth was actually down during the quarter. And that was due to a couple of sectors and a handful of stocks that had meaningful market caps within the mid-cap growth benchmark. They were actually down meaningfully, which kind of pulled down the overall mid-cap growth index.
As we look at that U.S. large cap category, measured i.e. by the S&P 500, what did we see from a sector perspective?
We did in the quarter see a little bit of variance. So healthcare on the growth side did fairly well, but the two largest components, consumer discretionary and technology, were actually only up about 1% or so. And so value actually outperformed growth slightly during the quarter. And I think really when you look at it, financials had a very, very good quarter on a relative basis, say, versus technology, hence why value did slightly better for the quarter. But then when we look at the year, certainly technology and communication services did so well relative to many of the categories in value, hence that outperformance.
Got it. And let's transition to the discussion on international. Obviously, I mentioned the fact that the US dollar being weak helped propel the international performance. I mean, these are the quarterly numbers, which, you know, Latin America, 8% for the quarters. That's a pretty strong number. And you'll see when we transition to the yearly performance that Latin America did quite well there. Any other major components that you want to touch on quarterly anyway?
Yeah, China was down, and so as a result, it did bring down the MSCI BIC. But I would note that China's performance for the year is very, very strong. So probably not surprising on a quarterly basis. It could have had a pullback just because it has done so well in the prior 3 quarters. Okay. So you'll see it was up 31%. Now again, Latin America kind of did the best in the 4th quarter and again for the year. And a lot of that had to do with natural resources. But in general, we're seeing very, very strong results globally within international.
It's about time.
Yes.
We've had a period where U.S. dominance has really prevailed. Now, again, the weakening dollar has helped here. The dollar continues to weaken, which we'll talk about in a few minutes. International may continue to have that slight advantage. As far as bond returns, going back to that discussion, what did we see?
We saw solid performance in the quarter. You'll see on the left kind of more of the credit areas. Emerging markets were relatively strong. But then when we kind of look in the middle towards the right, those returns were actually pretty good as well, with mortgage, Bloomberg Ag showing nice returns. When we look at the year, we'll see really the credits side, which is on the left, had slightly higher returns. But when we look on the middle to the right, which are more core, those had good returns year. I think what I would highlight is ultimately the relatively strong numbers for municipals for the year. But at one point early in the year last year, municipals were really struggling.
They were negative.
Yeah, and so it was a very good comeback within the municipal performance.
Yeah. And to your point, I mean, it's not really fair to compare 4.3% annual return with the ag at 7.3, because you're paying taxes on the ag. You're not necessarily paying taxes on the muni. So you have to take that into account.
Absolutely.
So that is the performance we saw for both equities and bonds, fourth quarter, and I guess for the whole year. As we look ahead, what are we expecting? Both, we'll start with the US economy, then let's touch on the international economy, and then let's go into the markets themselves. So from a US economy perspective, what do you anticipate is going to happen? And then, by the way, this is anticipate, right? Because nobody really knows.
Right. Absolutely. More or less, we're expecting much of the same of what we saw in 2025. So GDP growth should be fairly solid. At this point, there's a low recession risk for the year. We think that AI infrastructure spending should continue, and we'll address that in a slide. And we also think that the wealth effect likely will continue to fuel consumer spending, and we'll kind of talk about that. Inflation, it certainly maybe didn't go up as much as some people feared last year due to the tariffs, but we do expect that there's a possibility that it might tick up a little bit in the first half and then probably moderate. But again, we're still awaiting tariffs. And so this week, supposedly the Supreme Court will rule on the tariffs. And then when we look at the weekend and kind of the tariffs over the Greenland issue, that continues to be something out there. But we think many of the other components of inflation should continue to moderate. Then when we look at kind of the tax bill from last year, there is an expectation that tax refunds will be a bit higher and might help from a consumer spending standpoint, middle income and lower income part of the economy. And then again, when we look at the Fed, there is the potential for modest cuts this year. They're looking at the labor market, and so far, it doesn't look like they're going to be in a hurry in the first half of the year.
Got it. From an international perspective,
we expect solid global growth trends to continue, and we'll address that in a slide. Mm-hmm. Fiscal policies in Europe look to be more supportive of growth going forward. Central bank policy, though, is probably a bit more neutral. We have Japan kind of raising. The EU is probably more kind of in a neutral standpoint.
Got it. Well, you already mentioned a couple of risk to our outlook. Certainly, if this AI boom doesn't provide the productivity benefits that are anticipated, that's going to be a real disappointment for the markets, because there's a significant amount of money going into the build out of that infrastructure. Consumer spending obviously is always a risk because they drive 2/3 of GDP. So we'll talk about the K-shaped recovery. Right now, that doesn't look to be a concern, but again, certainly is a risk. You mentioned tariffs already and the Supreme Court ruling, which, you know, that could cause a little bit of market concern. If I think it's widely expected. I hope this isn't too politically oriented, but I think most think that, you know, there's a good chance the Supreme Court's going to come down against these tariffs, and then it's a question of what does the administration do to try and keep those dollars here rather than refunding the billions and billions of dollars that would have to go back. You mentioned labor markets, and I think you're right. Fed is really keeping a close eye on what's going on in the labor markets. More unexpected geopolitical risk.
Well, we had one that was unexpected right around the turn of the year, and now we have the Greenland issue.
Yes.
So yes. It's hard to say, but there could be another one.
There could be another one. You got it. And of course, now we got the midterm elections that we'll be talking about, which there could always be a little volatility as a result of that. So let's touch on that K-shaped economy though, because consumers drive so much of the economy here in the US. I mean, it's practically impossible to go into a recession if people are out spending. But when they stop spending, it's relatively easy. So what do we mean by this K-shape?
So if we look at the left side of the slide, you're going to see kind of that blue area. So that represents the top 20% of income earners in the US. And this is looking back really over the last 5 or so years. Whereas that bottom 80% is represented kind of by the black area. And so what you'll see is that basically the bottom 80% have spent 16 trillion in consumer spending, while the top 20% have spent 41 trillion. And so that's where the K-shaped idea comes from. So the top 20% is the part of the K that's going up. And so the economy has been very strong for that cohort, whereas the bottom 80% would be the bottom part of the K, where it just hasn't been as strong. And so that's kind of why we say that there's almost two economies. When we look at it in aggregate, it's been good, but certainly there are data points suggesting that with income inequality, that the economy has really performed differently.
Got it.
And then on the right side, what we can see looking at the bottom right graph, that is showing the projected tax refunds that we'll see this year, which are estimated to be up maybe 20–25%. And so that is likely going to be a positive impact for the bottom 80%. And the viewpoint is a good bit of that money will be spent. And so we could see that part of the consumer economy have a little bit of strength. And so when we talked about an unexpected drop in consumer spending, it would be if upper income consumers started to back off.
Got it. Yeah, and just to point out, you mentioned the tax refunds with the passage of the OBBBA, the One Big Beautiful Bill Act, as it's referred to. That really didn't provide much benefit for the top 20% income earners because a lot of the benefits get phased out at the higher income levels, whereas that's why we're getting more refunds for the lower 80%, just because they don't get phased out of as many as those tax benefits. AI investment, we put this as a risk. So let's talk a little bit more about it.
Yeah, so we know that many companies are still in that build out phase of AI. And so we have seen very strong growth over the last few years in AI spending. Now, on an absolute dollar amount, we're going to still see nice increases. Obviously, the percentage increase is coming down. And then when we look at the valuation of many of those companies, there could be a point from a risk standpoint where people say they're spending a lot of money, but we're not seeing the returns. Mm-hmm. That's really kind of the issue. But from the actual investment standpoint of the capital spending standpoint, I should say, that is expected to continue to ramp up over the next couple of years.
All right, with that, let's transition just briefly. I think we got a couple slides here on inflation. I know it was a really big issue back, prior year to maybe past 5 years or so. It's come down, definitely come down. So what are we seeing here?
If we look on the far right, you'll see kind of the April number, inflation was at 2.3%. By November, it actually had come up a little bit to 2.7. And what we were saying is potentially we might see a little bit more of the tariff pass through onto consumers this year. Maybe it ticks up in the first half closer to 3%, but then likely comes down as we lap that issue. And then also many of the components that had been leading to slight increases, those seem to be continuing to moderate.
And the problem with, talking about inflation is, I mean, look back to 2021, 2022, and you've got 7, 8, 9% numbers. We never, well, I won't say never. Energy's come down for sure, but broad-based, you don't really see deflation typically. So, yeah, the inflation rate, like the increase year over year is lower, but we still are working off a much higher base because of those years where we had 6, 7, 8, 9% inflation. That's just hard on consumers.
Yeah, that's a great point, because when we do look at it in aggregate, the general price level for many consumer goods is still up 20, 25%.
Yeah. Let's talk about global.
Yeah, so we had talked about that we think that kind of the global economic activity improvements should continue. And so if we look to the right side of the chart, you're going to see a lot of blue, greens and yellows. If we look back to 2021, 2022, you're going to see more oranges and reds. So certainly the global economy is doing better. Now some are right at that 50 or slightly below, but many are actually kind of in the low 50s.
And the 50 is like break point for expansion versus contraction.
Absolutely. So Brazil has been a bit weaker. We look at France, kind of that's right there. When we look at some of the other areas, we're seeing nice solid low 50s.
Got it. All right, let's go to our market outlook, less on the economy, or our outlook, I guess, less on the economy and more on the markets themselves. So as it relates to the equity markets, just taking kind of what you've said about the economy, we're expecting solid returns this year. It might be a little bit of a stretch to anticipate as strong as 2025. I mean, we've had 3 consecutive years now of very, very strong equity performance, pretty much across the board. But it's like flipping a coin. Just because we've had a couple of good years doesn't mean we can't have another good year.
Absolutely. This has actually happened 8 times in history since 1926. And interestingly, about half of those we saw a 4th year of solid returns, and in the other half we did not.
Yeah.
So below double digit, not necessarily down.
Got it.
So.
Yeah, and you had made reference to corporate earnings. I mean, we expect them to be pretty solid as well. We know valuations are high, but there could be reasons that you'll touch on why valuations are maybe a little higher than in past. I think most people believe that any additional returns are probably going to be more growth oriented, earnings growth than valuation expansion, but I guess anything's possible. We talked about downside risk. We talked about the consumer being a big one. Tariffs we've touched on inflation. But regardless of that, I think investors should always expect that there could be a mid-year pullback. They're pretty common, and we're going to see that in a slide or two, that pullbacks are not like signs of catastrophe. They typically are good entry points. And it's pretty common to have a mid-year pullback in any given year, let alone, this year's a midterm election year. International performance, we think that could continue to do well. I don't know if it's going to have quite the boost that it had from the real weakening dollar last year, but I don't think most people expect the dollar to have some sudden burst of strength. And then small caps. I mean, if the economy does continue to stay strong, and we don't transition into a recession that's unexpected, small caps do tend to do a little bit better in those environments.
And so far this year, they've actually done a little
They
bit
have
better.
done, yes, yeah, they have done a little better. Let's talk about investing during market highs though, because I know you and I and the rest of the advisors here at SilverOak, we get this question a lot. All right, you got cash, but the question is, should it be invested? We're at all-time highs. Shouldn't we wait?
Yep. So here, this looks at data going all the way back to 1950. And the light blue is saying if you invest in the S&P when it's at an all-time high versus green if you invest in other days. And what you're going to see is they look remarkably similar. So if we look at actually the 3-year and the 5-year, interestingly, it's slightly better if you invest at all-time highs. And I think what this is really just saying is that when the market is in trend, you are always making all-time highs. Yeah. And so versus periods where the market's weak, you still have to come back from that. Mm-hmm. But what this is really telling you is that market timing over long periods of time doesn't really meaningfully change your performance.
Yeah. And I heard it saying that today's all-time highs are tomorrow's good entry points. Meaning if you look back a year or look back 2 years, at that time it was an all-time high, but now you look back and you're like, dang, I should have put money in at that point.
Absolutely.
We talked a lot on consumer sentiment.
Yeah, we've shown it in other slides in past webinars, but what we've always talked about is that when consumer sentiment is low, is actually a contrarian indicator, suggesting that future returns will be relatively high. And so what's interesting is that we are near lows, but yet we exit a year where the stock market was fairly high. If we actually saw really strong consumer sentiment with that sort of market performance, we'd actually be a bit more concerned. Mm-hmm. And we're not saying that this year will be up, 18%, but this is kind of the average return since the late 70s when consumer sentiment has been in the 50s.
Let's touch very briefly here on earnings growth, just because, excuse me, this, at least in our opinion, is probably going to be a bigger driver of appreciation in the markets versus, expansion of valuations.
Yeah, so on the left, you're going to see that earnings growth for 2025 is expected to be about 11%. But when we look at 26 and 27, the expectations are, for 15% growth. Many times we start the year with numbers that are a little bit higher. So we expect those to come down, but we are again expecting relatively good earnings growth this year. And what is fueling that? If we look on the right side, you're going to see that, margins are actually now approaching the highs they were before the pandemic. And so company profitability is very solid.
Well, you had mentioned earlier a little bit about valuations and potentially markets being at what we would consider high valuations, but maybe it was justified because of makeup of the market.
Yeah, and we've talked about how the high valuations is really more of a situation where the markets are reflecting the strong fundamentals of companies. And here what we're showing is the composition of how the market has changed since the 1960s. So if we look at the green line, you'll see back then energy, materials, and industrials were a little under half of the overall economy, whereas today they make up about 15%. The other side of that is technology and communication services, which was a much smaller component at under 20%, where now it's roughly 40%. So a big shift in that dynamic. The reason that's important is that technology and communication service companies tend to have higher valuations. And so higher valuations are now a bigger part of the overall allocation of the S&P, suggesting that unless the weighting of technology companies within the S&P meaningfully changes, we're likely looking at higher valuations going forward.
Well, let's come back to the discussion as well on the currency. And I think it's, pretty evident based on even our discussion here that when you have a weak dollar, that gives a boost to those international positions when we have to convert the local currency back to US dollars and vice versa, right? A strong dollar would correspond to weaker international performance. Is there kind of anything that we should glean from this, though, based on the history of the US dollar?
Yeah, so if we look on the left side, you'll see that despite the dollar weakening maybe about 10% last year, roughly, versus the euro, it is still overvalued relative to other currencies in developed markets and emerging markets. A little bit of a difference, but maybe 15%-ish still overvalued. So one of the things we didn't talk about is, with the Fed potentially lowering rates a little bit more and the ECB kind of on hold, our interest rate differentials will likely continue to come down. That could put continued pressure on the dollar, kind of bringing the overvaluation of the dollar down. And that's really important because when we look on the right side, you're going to see that in periods where the dollar is weakening, your average monthly returns are actually positive, and vice versa. When the dollar is appreciating relative to other currencies, it actually provides negative relative performance versus the markets. Hence why we think that the trends we saw in international performance last year could continue this year.
One caveat: the currencies in general are exceptionally volatile, and interest rates certainly have a big component, but there are so many other factors that go into currencies. I'm always a little skeptical of making a call on currency direction.
Yeah, it's tough.
Yeah.
And again, it doesn't mean that we couldn't see a period in a quarter where the dollar did appreciate.
Right. Excuse me. If we look here, we get back to the discussion on volatility, and I'd made reference at one point that a pullback in the market's pretty common, whether it's in a midterm election year or not. And we're showing here that 3 corrections of 5% per year is, that's pretty common. Like 1 correction of 10% each year. 1 correction of more than 15%, we usually see about every 3 years. And then even a worse correction of 20+% about every 5 years. I think people, like back in April, when we had, actually in that case, we had more than a 15, maybe even in markets more than a 20% pullback back in April. But if you'd kind of freaked out, you'd let all of your kind of other senses make a decision, you probably would have sold, only to have missed this massive, not just recovery, but up 18+% year. Pretty astonishing. Let's talk about our outlook as it relates to the markets that are bond oriented or fixed income oriented.
So we feel going into the year they should provide stability. From a return standpoint, you're going to likely get the yield that the underlying bonds provide. With the Fed more or less kind of on hold for right now, and perhaps modest cuts from here, we don't really think the component of total return coming from price appreciation will be a big factor this year. Now, across the different types of bonds, we're still seeing very attractive yields.
And we see that here on this chart, showing us the various components, starting at the far left, U.S. Treasuries and municipals, et cetera, et cetera. And this is highlighting those kind of more attractive
Yeah.
yields.
So investment grade corporate bonds, kind of the credit area of the market, providing 4.8% yields. Interestingly, municipals, when we look at the taxable equivalent yield, which is what is shown on this particular slide, they're at 6.1%. And then if we look in general, the US aggregate, it's not on the slide, is around 4.3%.
So again, pretty attractive risk versus reward scenarios at this point.
Yeah, and again, if we kind of look at that US aggregate, that base yield is 4.3%. If we were to see a shift in interest rates of interest rates being down 1%, that performance would be 10.3%. But if we did see, say, interest rates unexpectedly increased, we're looking at a 1.7% loss. So this is not a scenario like in 2022 when yields were so low and interest rates went up. We saw those kind of double-digit losses from bonds.
Got it. All right, with that, let's transition our discussion into planning tips for the new year. And there's, I think there's some gems in here that I think a lot of folks that are on today's webinar can benefit from. First, don't adjust your risk tolerance due to recent market performance.
And I would say up or down.
I totally agree.
Because again, this is a year where some people are probably a little nervous with everything going on.
Yeah.
But again, with the economy and market trends being solid, that doesn't necessarily mean that we're looking at a big price decline.
You got it. Yeah. Of course, April 15th, tax filing deadline. So I know all the tax preparers are out there would really appreciate if you got your tax information to them as soon as possible. Of course, W-2s and those are probably not yet out. That's going to be later in the month. And then 1099s from, various firms, Schwab, Vanguard, Fidelity, all the others, probably in mid-February, maybe even a little bit later. And oh, by the way, if you do get the 1099s in early February, I'd probably hold them for a while because they tend to get corrected if they come out too soon. So you may file your tax return and then a week or two later get an updated 1099 and you're like, shoot, I should have waited. If you have foreign bank accounts, of course, don't miss the foreign bank account reporting requirements. Now, certainly the time to start planning for 2026 taxes and adjusting your withholding, making estimated tax payments, just frankly, just keeping good files of, charitable donations, or if you deduct medical expenses, making sure you keep those receipts. And think about 2025 spending. And, I'm not saying build a budget, but just look back at what your spending was in 25 to help it inform you going forward here in 2026. And then, of course, max out all your contributions. To the extent you can max out your 401k contributions, do so. The limits all increase, so these are the new limits. And for those higher income earners, just remember, if you're making catch-up contributions, meaning that you're 50 or older, those have to be in the form of Roth. I've gotten several communications from clients where they've gotten emails from their employers kind of mentioning this, and they're, oh, do I want to do it? Yeah, do it. I mean, it's you're not getting quite the tax benefit as before, but it's still worth doing. Like I said, max out on all your contributions, including here, these are the new IRA contribution limits. HSAs, if you have access to a high deductible plan that you can contribute to an HSA, I certainly encourage that. Review your estate documents. It's a great time of year to, as you're thinking about all your finances, to just take a look and who's your power of attorney, who's your healthcare directive, who's your executor, who do you have money going to? Is there a family member maybe on the naughty list or maybe one on the good list that you might want to make some changes for? Beneficiary designations tie right into that, obviously. Jonathan, from an investment perspective, this is a great time to rebalance.
Absolutely. So you'd want to review your 401k allocation and see if it's appropriate to make any
And
changes.
HSAs, that's where I see the biggest, like people, they make contributions throughout the year, but they forget to invest those contributions and they just set in cash. So don't, 401k is a great one. I agree with Jonathan, but don't forget your other investments like the HSAs. Look at insurance. I know this is a big one because insurance rates are going up a lot. So I think a lot of people probably have this on their radar just from a perspective of premium, but don't go short on coverage just to save on premium. You may end up very much regretting that decision. So I would still make sure that you're getting properly covered, even though we are seeing increases in premiums. If it's been a while, get a copy of your credit reports. You can do that free using this government site. You should also make sure your credit's frozen at all 4 of the bureaus. I know everybody's familiar with TransUnion, Equifax, and Experian. Those are the big 3, but Innovis is another one that I would suggest. Consider subscribing for title alerts. We sent out a communication probably a month or 2 ago on this. If you didn't get it, reach out to us and we can resend it to you. But this is subscribing to title alerts. Take a look at your Social Security statement. Consider creating an online ID.me account. Frankly, if you wanted to pull up your Social Security statement online, you have to have an ID.me account. You also have to have an ID.me account if you want to request your IRS IP PIN, which I would highly advise. Okay, if you don't have this, it's basically setting up dual authentication for the filing of your tax return. If you want to learn more about it, you can reach out to us and we'll give you instructions on how to do that. I think, what was it? Maybe 6 months, a year ago, somewhere we had sent out these instructions. So hopefully everybody's received those and done it. And then plan for charitable giving for the new year, whether you use your donor advised fund, you use your IRA in the form of QCDs, qualified charitable distributions. Just keep those in mind. As far as SilverOak updates, Jonathan, do you want to touch just at a high level on our IQs?
Yeah, absolutely. We look at the year, obviously equity returns on an absolute basis were very good, kind of leading with international, then US large cap. Our funds did relatively well. We had a few that did exceptionally well. We had a few that were a little bit below, but again, the absolute returns were high. And the returns on fixed income side, sure, absolutely were lower. But when we look at kind of our managers, lower than equity.
Yeah.
Yep, that's a great caveat. They actually did very, very well on a relative basis, really across the board in municipal credit and our kind of core funds.
Yeah, I mean, there were a couple that were up more than 10%. Unconstrained, I think we had an unconstrained position. Maybe one of the corporate bond positions was up close to that. So overall, a good year there. As far as our general updates, we actually just this morning started a build out of more space in our current footprint. So we have office being built right now. And this summer, as soon as we get through tax season, we're looking to implement several new technologies, including a new AI resource that we're going to be utilizing. And just this morning, I was on the phone with a couple of recruiters. We are hiring within our financial planning area. We're hiring within our trading area. And we're also potentially looking for a finance manager to bring on board. So we've got probably 3 or 4 positions that hope to be filled within the next couple of months. as we continue to grow and expand. So that's always great news. That's going to bring us to the end of today's webinar. If you have any questions, like I mentioned in the beginning, reach out to your SilverOak advisor or call me directly with those questions. And as a reminder, if you have topics for future webinars, I encourage you to reach out with those as well. With that, Jonathan, thank you, and the rest of the team, thank you. And for all those attended, we want to thank you as well. Have a great day.